We
Yes,
study our
sir.
colors, Marcos, before this episode begins.
Say it again.
Did we study our colors?
Oof, you really got me with that color. The thing was a great call.
Look up and see what other color I can use
I
to.
knew macaroni and cheese was one.
What? No, that was not a Crayola color.
I guarantee you macaroni and cheese was a Crayola color.
No.
Look at your inbox.
This is like some kind of a
Crayon.
2022 crayon that's written in Spanish.
Well, he just got canceled, dude.
Did you get the Latin version of Crayola? Like this is
Oh
not
my gosh. You bite your tongue.
macarones con queso, macaroni au fromage.
Cheese was a crayon color, I'm telling
This
you.
is a newfangled list of crayons. This
It's
was not a crayon.
newfangled nothing, dude. Newfangled nothing.
Macaroni and cheese. Aha. You know when macaroni and cheese started to be produced?
Like
Past the
the,
time that I was
the
playing with.
crayon itself?
Huh?
The crayon itself?
Yes.
1972.
No, that's what I'm telling you. It was not there in the 70s, not even there in the 80s. 1993 is when they first started using
And
macaroni and
that has
cheese.
nothing to do with it. We didn't say what year was it made. You were challenging whether or not it was even a thing.
And you can only get it in a box of 64 crayons. It does not come in a box of 16, 24, or 32.
Yeah. What else does that box of 64 come with?
Red?
A built-in sharpener, Brett.
Yeah. No, for crayons? What are you talking about?
Oh, I gotta get
Crayons
out of
have a
here.
sharpener?
Of course they do. If you want properly sharpened pencils to make sure that you're coloring in between the lines and within the lines.
But crayons are not made with pencils. Crayons are
No,
are
they're not. They're made of clay, of whatever the hell they're made of.
yeah, we're not sure exactly.
They're made of crayon. We're going deep. Hold on. What are crayons made of? I'm
Um,
asking ChatGPT though.
wax. I'm gonna go with wax.
Crayons are generally made from a mixture of paraffin wax and color pigments. So you win. Had I thought about it longer, I probably would have had to say wax instead
I
of
feel like
whatever
if
I
you
said.
put
I
if you
said I said clay.
it's okay. We won't show that part.
That's so funny. Welcome to episode 41 of Talk Your Chart. My name is Marco Segura here with my colleague and co-host Brett Horowitz. We are recording today, August 29th of 2023. Brett, have you heard of the 10-year Treasury? So have I. My first chart is talking about the 10-year Treasury.
Let's do it.
Why? What do you
Why?
got?
Because it's going up.
Yeah, it's definitely going up. So what happens when rates go up and their impact on stock prices? We obviously know it hasn't been good. 2022 was the lion's share of that. Recently, we've had a big uptick in the 10-year Treasury, given that Jerome and his friends at the Fed are trying to talk rates up a bit to make sure inflation doesn't get uncouthed and completely out of the wagon, although we've literally had 12 months of decreasing readings. So these two charts that I have consecutive are a little bit of the relationship between the 10-year trade, the 10-year Treasury and the S&P 500. The first chart here is specifically showing the moves that are 30-day changes in the 10-year Treasury and how stocks performed over that same time. So looking at it just from 2021 to today, if the 10-year Treasury was up, which was 64% of the time during that time period, stocks fell 0.15% on average. And if the 10-year rates were down over a 30-day period, the S&P 500 gained 3.1% over the same time. So at least for this kind of observation period when rates were doing their thing, you see a clear relationship, kind of a negative relationship where rates up, stock prices down, rates down, stock prices up. Any thoughts before I jump to what is probably more meaningful?
Well, I think a couple of things. In the last month, I just checked. The 10 years gone from started at 4% about a month ago. It's now over 4.2. It did hit 4.3. As we've talked about, the reason that stocks tend to go down is because you now have a competitor to stocks. You can buy bonds at a higher and higher interest rate or cash or CDs. But I think while this is clear, there's a negative correlation. It doesn't mean that every time it's going to be down, right? I think the first thing you think of your client is say, well, with rates going up, why would I want to be in stocks right now? And I know you're going to show that more over the long term in the next chart, but even short term, right? There's plenty of instances here where interest rates have gone up and stocks have gone up as well. So it's not like you can use this to then predict the next 30, 60 days, whatever it may be.
No, not at all. And it's actually funny. The quote unquote long-term chart, it's not even long-term. It's just a 12-month relationship. Real quick, we are at 4.2 on the 10-year treasury. That's back to a number we saw in 2007. So there you go. So next chart, as I pull it up here, we're looking at the same relationship. So again, the 10-year treasury and the S&P 500, but in this case, we're looking over the last 60 years. So a meaningfully long period of time relative to the 2021 to now. And it's looking at basically what happens over a 12-month period for the stock market relative to a month's move in the 10-year treasury yield. So if the 10-year treasury climbs 50 basis points, what happens to the market after 12 months? And what's funny, and here's just the kicker of it, if you look at this chart and read it appropriately, higher yields more often are assigned to lean into stocks than to run away from them.
Well, this is what I mean. When I talk to clients all the time, I'm constantly telling them you'd rather have interest rates go up than go down long term, right? Because interest rates going down is usually happening because the Fed is saying we need to stimulate the economy. The economy's not doing well. And so maybe you get a short-term bump in your stocks and a short-term bump in bonds, but overall you want bonds producing 4, 5, 6% returns so you can make some money on that. That's a sign of a healthy economy. You don't want interest rates to be next to nothing, as they've been for the last 10 plus years. And you saw that in bond returns. They've been at 1 or 2% for that 10-year period.
Yeah, there's short-term pain, but ultimately we do want a more neutral position for interest rates, which we're getting to now. So that's it. Yeah, rates are moving up, might hurt stocks over a short period of time, but ultimately, if you have a reasonable window, you're going to benefit from rates going up.
We've also seen the last few weeks the market stumbled a little bit. I think part of it's based on the interest rates that you talked about, but also it's the news that's come out that people are a little bit more optimistic going forward about the economy. We talked about it last episode, how some of the readings were pretty good. And so I want to share with you the first chart here. This is a forecast that the Federal Reserve of the Federal Reserve Bank of Philadelphia put out. They forecast, or it took 37 forecasts from different professionals, and they laid out what they think professionals see. So we've got 3 columns or 6 columns, but 3 main parts of the first column, the first chart: real GDP percentage, unemployment rate, and then payrolls. So we can see here GDP, everyone's expecting a higher number for Q3 than was previously predicted, a lower number for unemployment, and more payrolls. And then I also circled sort of the trends going forward in 2023 to 2026. And you can see real GDP is solidly positive in all those years. And the unemployment rate, as we would expect, should be ticking up because it's near a 50-year low right now. So before I move on to the next, what do you think about their predictions? Obviously, they're going to come true because they know the future. So, no. What do you think?
I think 2 things. Number 1, professionals are correct less than 50% of the time. That's number 1. Number 2 is they're predicting the soft landing, the elusive unicorn that Jerome and friends of the Fed are trying to pull off. I don't like the landing of the plane analogy because I think it's a constant thing. But this is just showing a soft landing. This just makes me think that my call of recession starting this year is a good call.
Well, let's go to the professionals then. Second chart, the risk of a negative quarter. So this is the risk of a negative quarter of GDP. Okay. And this is what the forecasters predicted for Q3 of this year, Q4, and then the first 3 quarters of next year. And they have lowered their percentage of a negative quarter in all those quarters precipitously in the third quarter. So it's pretty unlikely it's going to happen starting the third quarter. You've always said maybe the fourth quarter is when it starts. So you're, I guess, with the 34% that expected to happen in the fourth quarter.
Look at that. My percentage just went up after seeing this.
You would be contrarian, huh?
Contrarian, let's do it. Also, I got to look at that Atlanta Fed everyone just go to gdpnow.com. It gives you the Federal Reserve Bank of Atlanta's prognostication on expected GDP for the quarter. That's popping everyone's eyeballs at right now a current reading of 5.9%. So that's pretty hot. Pretty
Yeah,
hot.
I would just going back to the first chart. These are real GDP. So this is GDP over and above inflation. So when you
Okay.
talk about inflation of 3, and you talk about GDP of 1.9, that's an estimate of almost 5%. So
Yeah,
that's why
yeah.
maybe the numbers you just mentioned are a little different. Last chart to talk about, which makes me the most excited if they're correct, is these inflation readings going forward quarter to quarter and year over year. And so there's a lot of numbers here. Basically, if you look at the next few quarters, everyone expects inflation rates to start to come down. It's not going to be even. It's not going to be every quarter, but the trend is in our favor. And then looking out 2023, 2024, and 2025, we're now in a range of between 2 and 2.5, depending on the inflation reading. We're going to talk about the difference between CPI and PCE in a little bit, but all this, if it can come true, is why everyone thinks a soft landing is likely to happen if the current trend continues.
Okay. Yeah, it looks right. If you look at the 5-year tips break even, that's now at 2.25. That spiked in March of last year at 2.7. So if you've had people kind of measuring expectations, they haven't really gotten out of whack. When do they get out of whack? A year before that, in March of 22, when it was only 3.6%. So the market's still been expecting all this stuff to come down, even as it's been rising and rising and rising. I still think, and this is coming out of Jackson Hole, where Jerome gave, I think, a pretty measured speech. It's so funny to see how many different people interpret his word so many different ways. The tea leaves are interpreted in meaningfully different variety depending on what book you're trying to talk. I thought it was pretty measured, to be honest. But I think he has to make sure that people don't think they're going to cut rates anytime soon, because if inflation is a behavioral phenomenon, and I think it is based off what I've read, perhaps I'm just not intelligent enough to appreciate the other theories. He has to make sure behaviors align with the Fed's goal. And I think the only way he can do that appropriately is by taking a very measured stance, but also not letting the market think that rate cuts are around the corner.
Yeah, I mean, he needs to be serious. And I love the comment, lots of questions about why don't we just change the inflation target from 2 to something else, to 3. And it's like, yeah, like if you want to just make something up and just change it mid playbook because you just want to for the results, go for it. But it doesn't make any sense. Been
Yeah.
2 forever.
If it didn't feel made up before, that would surely make it feel made up.
Well, yeah, right. There's no science behind 2, but just to make it 3 so that we say, oh, we're actually closer to a target than we thought, like that's just a little bit silly.
I can get behind that. I can get behind that.
Well, this week we've got 2 really important pieces of information coming out. Thursday we have our PCE, the Personal Consumer Expenditures Index, coming out, sort of the Fed's preferred inflation number.
Brett, I guarantee you that will be the most important CPI print and PCE print until the next one.
Well, that's true. We also, though, have on the backs of that on Friday, we have the jobs report for the month of August. So we've had these like kind of good, not so bad numbers. We're hoping they're not too good. Hopefully they're not bad. But that's going to really change what the Fed does between now and when they meet in late September on their next meeting to decide if they're going to raise rates or not.
Yeah. I think they feel no pressure to cut in September.
Yeah, right now they don't. Those numbers though could change that.
Excuse me. I think they feel no pressure to hike in
Right,
September.
right. But those numbers could change it. If the number comes out dramatically different in this readings between Thursday and Friday, all bets are off what they would do.
Yeah. PCE. I'll give it another 0.3 month over month.
Yeah, 0.2 is better, but I'll 0.3 be okay.
0.2 would be better. Yes, that is less than 0.3. Yep. Well done.
Captain Obvious here speaking.
Well done. Well done. All
So
right.
my last chart here is about PCE versus CPI. And most people I don't think really know the difference or care about the difference. Basically, the CPI is data from households. PCE measures goods and services based on gross domestic product. Other reasons why the Fed likes PCE, because it's based on weightings on substitutes. So when people stop having meat and they start having spam, or they stop having bacon and start having pork, I mean turkey, this thing would substitute for that. The PCE is also more comprehensive. It doesn't look at just urban consumers, it looks at everybody. And so since 2012, the Federal Reserve has been using PCE as its de facto. Is inflation falling? Is it going up more than what CPI is doing? And most times here, going back to 2000, it's been fairly close. To me, we're kind of probably the farthest it's ever been apart, right, in this chart, in the last few quarters.
Yeah, 2011 had a spike, but yeah.
So we see that PC is coming down, CPI is coming down. PC is the lower figure right now. And so we need that to continue, because right now it's certainly above the trend that it's been year over year for the last 20 years.
The BEA, or the Bureau of Economic Analysis, is the one that calculates the PCE. Bureau of Labor Statistics calculates the CPI. This is, one of those fun little economic differences to look at, but ultimately they're both directional measures. So we want them both going in the same direction.
Yeah, I mean, I think without the wage is probably the biggest piece that they're going to have trouble controlling and bringing inflation down if wages keep going up as the rate that they're going up.
Yeah, they're turning. But look at all these labor unions. I feel like we're in the 1950s again?
We need to start a union here.
There's a lot of people on strike. I was actually talking to a few people about that. I think there's consensus, and Avensky can't fold this union.
Really? People want to go on strike?
Maybe we talk about that offline, huh?
As a board of manager, that's a little scary. But I want to talk about your chart that's got some more burnt sienna in it.
No, I did that one for you. Burnt sienna.
We learned that burnt sienna is a color.
I stand corrected, and I stand as a man who now knows a new color. Burnt sienna. It exists. China. Everyone's talking about China. First it was China's going to take over, and now it's China's dead in the water. It's just, again, so funny how narratives change. So China's having economic troubles. Let's not get into that. Let's just talk about exposure to China as a percentage of total exports and GDP. If you look at the purple bar, right under the purple and the burnt sienna bar is the country represented in the bars, and ultimately just the percentage of total exports of the US or the Europe or Japan, not JP Morgan, Japan, that go to China. So if you look at the actual implications of what it would mean, it's not a big deal. Is it good for the global economy? Absolutely not. But our specific exposure is just not it. I pulled this from Wells Fargo. The comment that came with it is, the relatively small effect on economic growth in these major economies reflects limited exposure to China. Total exports are equivalent to a relatively small proportion of overall GDP in large economies. And ultimately, let's say there was the quote unquote hard landing in China that was just unavoidable. US GDP growth would be projected to be reduced by 0.1% in 2024 and 0.2% in 2025. That's not good, right? You don't want a reduction in GDP, but just to kind of frame the magnitude of the reduction of not what's currently happening in China. If things got materially worse, there'd be a 0.1% and then a 0.2% reduction in 2024 and 2025 GDP, respectively.
Yeah, I mean, this is why, the portfolios that we build for our clients don't have a gigantic exposure to China in them, because China is it's an expanding economy, but still it's kind of relatively small, especially its impact on us. But I also think that, and also JP in this chart is Japan, in case people were not sure what that was. It's not someone's initials.
Yep.
But, when I think of China, I only think of Mr. Trump and how he would say China. And it'll be interesting to see how this chart will change if he gets reelected, because that's been very muddy relations ever since he was elected, and how we deal with China and how much we import and export and tax and things like that. So we'll see how things change if he gets elected.
Oh, yeah. Oh, we've talked about probably 2 or 3 headlines that have just flipped on their head in today's episode. In maybe next week, a month from now, 2 months from now, all we're going to be talking about is the election. So can't wait. Can't wait.
I can.
Me too. Brett, as always, thank you for your time. Burnt sienna, take it to the bank.
Yeah, by the way, one more comment just before we head out, because then we got a couple minutes left here. We know that student loan forgiveness is about to end. There's a lot of people now going to start paying student loan payments again. I read a story that it's very, very complicated for people to understand how much to pay, when to pay, who to pay, because providers have changed over the years. There was also a great story in the journal this morning about the fact that the average person, when they're in their 50s, starts to actually gain and have a reasonable amount of financial acumen. But talking to clients, I would say if you're not in your 50s, or you are but still don't have it, this is why financial planners can be so valuable in helping you work through these issues. And so I would encourage anyone who's watching or on listening, if you have friends that need financial advisors or not sure about what decisions to make on some of these things, like this is how you can beat the masses, is work with someone professional and not try to figure it out on your own, because it's very complicated out there.
Here, here,
That's my PSA.
here, here. Service professionals until the end. Here, here.
Okay, let's see how the numbers shake out Thursday, Friday.
Until next time, Horowitz. Thank you, man.
Have a great Labor Day weekend.